Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing that we're going to do is open up our brokerage platform, and the one we're using is Tasty Trade. Feel free to use whatever you like. And because we're going to be writing options contracts, we're going to be dealing with options contracts, we need to know where we stand with regard to the options cycle. So we just want to open up any underlying. This is UAL. This is a position that we're currently managing that's just gone completely against us. But ordinarily, instead of having to just take a loss, we're actually managing the position. We're trying to work it back to a scratch. So any underlying, and you just want to see a list of expirations, and we've got weeklies here and month and everything else without an orange W is a monthly. We want to stick with the monthlies, and we want to be between 30 and 60 days out in time. So we've got October 18th at the top, which is 2 days away. That's far too close. And then below that, we've got November 15th, which is the next monthly. That is 30 days away. And you could go with the November 15th, but if you go one further below, we've got the December 20th. That's 65 days away. Either one would be fine. I think we can just go with December 20th. At this point, I probably would cycle over to the behind month, which is December 20th. So we know we're going to be about 65 days out in time. So we can take this information, come over to our watch list, and we can exclude any underlying that has earnings over the next 65 days. And the reason for this is because we don't want earnings to come along and disturb our trade, as it will increase volatility and it will almost certainly mess up your deltas. And both of these things will have a negative effect on your P&L. So we want to stay away from earnings, and we'll have a better time in our trading career. We also want to filter out anything that has a low liquidity rating, and the reason for this is simply because we want to be able to get in and out of positions easily, and we don't want to be paying high spreads. We want tight spreads, bid-ask spreads. So filter out those two things, and then finally sort everything from high to low IVR. We want to sell when volatility is high and play the contraction. Volatility is mean reverting, so we want to sell when it's high. We are going to be shorting, so we sell high and then buy back low later. So now we have this list in front of us, and before we start going down the list, we want to make sure that we keep in mind what's already in our portfolio. If you've got for example, we have an airline company in our portfolio, we're not going to then start looking at more airline companies. Just use common sense. You can use things like beta weighting, but if you don't know how that works, just use common sense. If you've got food companies, don't look for more food companies. If you've got real estate stuff, don't look for more real estate stuff. If you've got airline stuff, do something else. Keep it diverse. Use common sense and you'll be fine. So with that in mind, just go down the list and see what would fit well in your portfolio. Ideally, you want to keep to things that have an IV rank of 50 or more. Sometimes above 50, above 30, can be okay for certain underlyings, but generally speaking, above 50 is what you want. And you also want to have a nice and healthy raw IV level. So IV rank and actual IV are two different things, so keep that in mind. So at the top here, we've got SLV with an IV rank of 76, and it's got an absolute IV of 37. Below that, we've got CL, we've got USO. This is just crude oil. EWZ, GLD. If we have a look here, we can see EWZ hasn't. GLD just overtook EWZ, but we've got EWZ with an IV rank of 69.7 and GLD with an IV rank of 69.9. So they basically have the same IV rank. However, if you look at the absolute IV, one has an IV percentage of 17 and one has 32. So that makes a difference, and you will almost certainly collect more premium with EWZ in this case. Relative to the size of the underlying. So another thing to keep in mind is the size of the underlying. So this is trading at $28. GLD is trading at $247. So you want to, and as the more you do this, you'll get a feel for it. You want to pick something that has a healthy, that that is of a healthy size with a healthy IV rank with a healthy implied volatility. It's not just straightforward. You wouldn't want to code software to pick something for you. You can, but there is a bit of intuition involved. So with that in mind, I think we can have a look at GLD. XLU might be okay. In fact, let's have a look at XLU. It's got an IV rank of 69. It's trading at just under $82, and it's got an IV percentage of 20.6, which isn't too bad. It is an ETF. ETFs are nice because they generally have less volatility, which of course is a bad thing for us, but you eliminate company risk, which is a good thing for us. And overall, it will lead to a slightly smoother P&L in your portfolio. So if you have a look at XLU, of course, we can just go straight to the December 20th, and now we are presented with the options chain. This horizontal orange bar shows you where price currently is, and the vertical bar shows you what the expected move is of XLU over the next 65 days. So we want a high probability of success. So how do we do that? How do we engineer or create a trade that has a high probability of success? How do we essentially make money? Because the way writing contracts is different to what you are used to seeing on YouTube in terms of the way that people teach how trading is done. Not to say that they're wrong, I'm just saying that this is different. So how do we make money from this? Well, there's two types of contracts. There's calls and puts. And we're going to be writing or selling these contracts and collecting a premium in return. So what contracts do we write and where do we write them essentially? Well, we're going to keep it really simple. We're going to write one call, one put, and we're going to sell them outside of this expected move, and that's going to lead to a high probability of profit. But we don't want to sell them too far outside of the expected move to the point where we're not really getting paid very well for the risk that we're taking. So I like to go anywhere between a 15 and 20 delta on either side. So if you look at the delta column here, we've got a 16 delta, which is perfect at the 88 strike. And on the put side, we have a 17, we have a 15 and 17 delta. Either one would be fine. Let's just go with with the 15 delta at the 75 strike. And as you can see here, these red bars represent the contracts that we're going to be selling, and they are sitting very nicely outside of the expected move. And this green bar here shows you our break even, and our break evens extend past our strikes because we are collecting a premium. This is the premium down here below that we are collecting. So our break evens would be on either side. For the call side, it would be 88 plus 1.05, and on the put side, it would be 75 minus 1.05. Hence why our break even points extend past our strikes. And of course, we wanted a high probability of profit. And if we look down at the bottom left, we've got a probability of profit of 72%. Anything over 50% is a high probability of profit. And if we want to get out of this position at 50% of max profit, we can do that. And we've got a 90% chance of being able to do that. So very, very high probabilities. This is a beautiful trade. Our broker is going to require just over $1,000 in buying power. So we've got a return on capital there of about 10%, give or take about 10%, just slightly above 10%. After fees, commissions, whatever, it probably will be about 10%. We've got a unlimited max loss potential here because this is a naked position. There is nothing covering our shorts. And we would have $2 of daily theta decay. If $1,000 was a bit too much for you, or you just don't like the look of having an unlimited loss potential, although you can manage risk and you wouldn't really actually take an unlimited loss. But just for argument's sake, let's just say $1,000 was too much. By all means, you can just buy another contract a little bit further out to cover yourself. So let's say we've got a contract, we've got a short at 88. We can just buy a contract here at 90, $2 down. Do the same thing on the put side, $2 away, and we've basically created a $2 spread on either side. That's stopped it from being an unlimited loss, and it's actually made the max loss defined. It's defined by the spread of the two contracts minus the premium that we collect, and that is our max loss. And the reason for that is because once we collect the premium, nobody can take it away from us. Now, In doing so, we do now have a slightly lower probability of profit, but we have a higher return on capital trade here. So that's the trade-off, and that's how you can find and manipulate positions to fit inside your portfolio. By all means, you can just, let's say you want to go a bit further out, $4 wide, by all means, you could do the same thing. As you can see, you will collect more up front, but you will have a lot higher max loss. So this is how you can play with positions. And in addition to this, you do need to know about the sizing of your positions. You need to make sure that your position sizes are correct, because if they're not correct, doesn't matter what you do, eventually things will end badly for you. So let's just say, so we've got a position sizing template here. It's free to use. Everybody can get a copy of it. The way it works is you enter in the size of your portfolio. So let's just say if it's $15,000, and then below that you enter in what the current VIX level is, say if it's 14.1, and everything below will then be automatically calculated for you. At this point, all you need to do is use this information to form the backbone of your portfolio, and over the long term, you will be just fine. To get a copy of this, link in the description, head on over to the free position sizing template and it will take you to where you need to go. If you want to learn in more detail and follow along on our positions, see what we're doing behind the scenes, how to manage risk, how we effectively manage losers back down to break evens, sometimes even slight profits, all that kind of good stuff. Link in the description. Click on EDS Premium, get yourself signed up. Inside you'll have exclusive access to our portfolios. That's where you can see what we're doing, all the adjustments, everything in real time. There's a full course, so no prior knowledge is required. We will teach you everything you need to know. It's a private community, so if you still get stuck, you can speak to like-minded individuals and myself included. There's a 100% money back guarantee. So if after 6 months you studied our full course and followed our trades and haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's risk-free on your part. It's £1 a month right now to join. The price will be increasing. 3 people are already in. There's 2 slots available at £1 left. Once they're taken, the price will be increasing and it will never come back down. Once you're in, you don't need to worry about price increases. You're locked in at that price. So you are rewarded for getting in early. And with that being said, I will see you guys on the inside.